these are slides for Chapter 14, the basic tools of finance. When you think way back in Chapter 2, when we were talking about the factors of production, we mentioned that you need land, labor, and capital, right, to start a manufacturing company. Some economics textbooks say entrepreneurship also, but our textbook gave those three. And remember what I said about capital. As a factor of production, it does not mean money. It means physical capital like equipment and machinery. But now we are talking about financial capital. And where does that come from if you were going to start your own company? Well, you might need to go to a bank and convince them that your business plan is sound and that you're going to have a good idea that's going to be profitable in the future. Or you might find an investor who has saved up money and has that financial capital, or maybe you've saved up enough money and turned that into an investment. So financial markets, we're talking about the coordination between those two things. And as an investor, if you're going to convince somebody to invest in your business, they're going to want to know the risk involved and want to know that the profit or the returns in the future is going to be worth the risk that they're taking on. Now, investors like low risk and they like high returns, but it doesn't always work out that way. Sometimes the projects that have the most risk, there's the possibility of most return with those. And so investors have to balance those two things. Just a couple of definitions. Bonds, we've mentioned these before. This is what the Fed buys and sells to manipulate the money supply. But we also know that the federal government also can sell bonds to finance deficit spending. And there are other bonds out there, not just government bonds. This building was built with bond money. We've got municipal bonds. So there are different kinds. But remember, what a bond is an IOU, right? You give me your money now, and then I will return it to you in the future. You might get a little bit of interest along the way. And we mentioned that it has a maturity date. We've got different kinds of bonds like 10 years, 20 years, even 30 years. And so at a certain period of time in the future, it's going to mature and you'll get the face value of your bond back if you don't turn it in early. Now, a stock is a little bit different in that it doesn't have a maturity date. This is a piece of ownership in a corporation. All right, this is just like you buying your binder or your backpack. That's yours now until you decide to do something with it. You're not going to get your money back in 10 years, right? So it's a little piece of ownership in a corporation. So you all might remember when Facebook went public. Okay, so they went from a private company to a public company where people could, it's probably hard for a regular individual, but little pieces of, we just call them shares, little pieces of ownership in that corporation entitles you to some of the company's profits in the form of shareholder earnings and dividends along the way. So if you owned a lot of the shares in a business, maybe 46%, 50%, that would be a lot, then they would might listen to your opinion at shareholder meetings. If you only own one or two shares of a corporation, they're probably, that's not a lot of stake in a company. A couple other definitions. Mutual funds is a little bit different. Okay, for your extra credit project, remember I've posted that in Blackboard. You can go ahead and invest in different companies and different stocks. I've given you $10,000 of play money, and you can just log in and pick which stocks you want. And y'all are going to be able to see how much it costs per stock. Well, let's say that you're a college student. You don't have thousands of dollars to get started investing. Maybe you have $50 a month or $100 a month to get started investing. You could buy a mutual fund, which has fractions of shares. So a mutual fund manager, and Brian might be able to explain this a little bit better than I do, they would pool a lot of people's $20 together or $50 together, and then buy several stocks from several different companies. And so each individual person who's only invested a small amount would own a fractional share, a fraction of a share. And you all already know that a market is a group of buyers and sellers. So when we're talking about the stock market, we're talking about trading these pieces of corporations that people can buy and sell. Right. The New York Stock Exchange, how many people have seen those letters before on the news? All right, this one is the largest stock market in the world in terms of the dollar value of the stock. So if you've seen the pieces of paper all over the floor, they buy and sell with an auction style. The second one is also in New York, but those are some smaller companies that we see in the second stock market. How many people have heard of the NASDAQ? Okay, so most of our technology stocks are traded on the NASDAQ, and that's done electronically. Just like if you chose to do the extra credit, that's all done electronically. You just select what you want and then press buy or sell. And I probably should have put these on another slide right here, but these are indices or indexes, and so these are names of stock markets, these are names of indices, so these are numbers that give us an idea of how the stock market is performing. Okay, how many people have heard on the news? The Dow's gone up or the Dow's gone down. Okay, that is a weighted average of stock prices for it's not the top 30 firms. There's like a committee that decides who gets to be on this list of 30. Here, I'll show you all who you want to recognize some of these companies. So they're not the biggest ones. They try to get a representative list, and it's a weighted average of their stock prices. Okay, this symbol out in front is called their ticker symbol. So when you're buying and selling stocks, you're going to need to know the symbol for that company. And if you don't know, you can just Google it. It's easy. So y'all have heard of Caterpillar, Boeing, Disney, ExxonMobil. All right, these are big companies. Okay, why are we paying attention to their stock prices? All right, let's pretend I haven't written the final yet. And let's pretend I want to see if it's too hard or too easy. And so I pick the top 3 students out of the class, and I give them the final. And let's say that all of them fail it. What clue does that give me about how the rest of the class is going to do? Okay, they're going to do even worse, right, than my top students. And so when the Dow's going up or going down, this gives us an idea of how some of our largest firms are doing and their stock prices. If they're going down, the value of those are going down, that means that people are selling. There's not a lot of consumer confidence, or not as much investor confidence as there was before, and so that's going to contribute to the Dow either going up or down, and that gives us an idea of how the stock market's doing overall. Okay, this stands for Standard & Poor's 500, and so this is another number that we follow. Of course, it's going to be made up of 500 firms instead of 30. It also gives us an idea of how everybody's doing. And then the NASDAQ is a stock market, but there's also an index called the NASDAQ. So you might see that reported, that number going up or down too. And we use these indices as a possible economic indicator of what's going on in the future, because why would you buy some stock in Disney? Why would you buy some stock in ExxonMobil? Because you think that there are going to be future profits, right? And if you're not so sure, then you're going to start selling. And so that's why we pay attention to what the Dow is doing or what the S&P 500 is doing. Okay, something else that we need to think about when we're investing is simple versus compounded interest. I think I've asked this before. How much interest are y'all earning on your savings accounts at the bank? 2%? 1%? Almost none, right? All right, so in my example here, it'd be a miracle if you could find that right now. I don't think you'd be able to. But we've talked about the federal funds rate, how low it is right now, because the Fed's trying to stimulate the economy by buying bonds. So if you were to deposit $100 in the bank at 5% interest, okay, here's the formula. So your $100 is your present value, this present value of your money. By the way, you're not going to need to calculate this, but you do need to know the difference between the future value and the present value and what we're talking about here. All right, here's the formula for you. Take your present value, you put your interest here, and n is the number of periods that has passed, that has gone. Okay, with simple interest, you're always using your original present value in the formula. If I told you that compounded interest is when interest is building upon interest, okay, what's going to change here? We're going to take that 1 of 5 and put it where? Here. All right? And then this is going to be a bigger number, and then this number is going to go here. And interest is going to build upon interest. So this isn't going to happen in a savings account. You need a special account to do that, such as a 401k. If you work for a public firm, when you graduate, they'll help you out and set you up a 401k. If you are a teacher, like me, you might have a 403b. You need a special account in order to have this benefit and to be able to invest and to buy stocks. So with $100, it might not be that big of a deal when we're talking about a couple of years, but we're talking about 20 years or 30 years. By the time y'all retire, that's a lot of money. You're not working any harder, you're just putting your money into a savings account versus an account where the interest is compounded. And y'all can see the difference there. Remember the rule of 72 we talked about with GDP? Do y'all remember that? It was the day the computer wasn't working. I wrote it up on the board. If you know your growth rate, so let's say that you've invested your money at 3%, this tells you how many years it'll take for your money to double. About. Okay, so 72 divided by 3 is 24. And then if this is assuming compounded interest. So that's what your author was talking about in chapter 12. Okay, you do need to know the relationship between risk and return. Like I said, investors like low risk and high returns, but riskier assets tend to pay a higher return to compensate for the extra risk of holding them. Now, these are averages. I do want you to know these numbers, but remember, this is average over 200 years. We know interest rates are really low right now, so, but average over the past 200 years, stocks, 8%. For short-term government bonds is 3%. Okay, so which one's riskier based on this? Stocks. Do any of y'all drink Monster drinks? Well, downstairs in the bookstore, you can get one, but y'all know what I'm talking about, right? You probably recognize the logo of the can if you saw one. Okay, do y'all remember people getting sick? People dying from them because of the caffeine content in there. And then Monster was saying, well, it's not our fault. This person had an underlying heart condition. But what did that do to their stock prices? All right, with all of that press. So, they can go back and forth and argue, should we have other warnings on our drinks? But it's risky, right? What if you had a bunch of stock in Monster? And then that happened. It's risky. It's not guaranteed that you're going to earn money. But for a bond, with that 10-year maturity date, is it guaranteed that you're going to get the face value back for a government bond? Pretty much. Pretty much. You're going to get it back. Okay, here's a graph that just illustrates the trade-off between risk and return. And one of the most important decisions that you're going to make when you start investing money is how much money do I put in stocks and how much money do I put in bonds. If you just can't argue with the rule of 72 and compounded interest that there is some benefit there, but your decision in terms of how much do I put in riskier assets, how much do I put in safer assets is going to really be important and determine what's going to happen 20, 30 years from now. This is also known as an efficient frontier. So if you were to think of it in terms of maximizing the capacity or maximizing the returns that you were able to get, if you are younger, you have some more time to hold on risk or to hold on to things like stocks. If you are getting ready for retirement, you probably want to be somewhere closer here and have your money in safer assets. Also, another reason why I want you to know these numbers, I know they're just averages, but if you get something in the mail saying, come to this dinner, promise you 20% return on your money or 30% return on your money, and y'all just throw that away. I think Bernie Madoff, Brian, you might remember, but what did he promise? Probably, y'all have heard Bernie Madoff. Ponzi scheme. Okay, he was promising, I think, close to 20% returns, and people believed him. And if you knew that this was the average over the past 200 years, then you would have been a little more skeptical of his claims. All right, so what can you do to protect yourself? Yes, you have to decide between stocks and bonds, but also you have to decide between which companies. Okay, well, what if you bought stock in Apple and Google and Netflix and said, oh, I've got a diversified portfolio. I've got a really diversified portfolio. I've got my money spread out across several different companies.
You asking if there's still risk or what?
Well, what does that sound very diversified to you? If I've got those are all technology firms, right? That would be a really, really bad idea if I did that right before the technology bust. But not only do you want your money in different firms, but different kinds of firms, different kinds of industries. You want to protect yourself against firm-specific risks, so Monster not doing well, or Enron, one of the top energy firms in Houston. Nobody expected that there would be an accounting scandal and that they would, be bankrupt. So you can protect yourself against firm-specific risk. Okay, but market risk is still there. Okay, what do we call it when we've got alternating periods of rise and decline in economic activity? That's always going to be there. We've talked about this before with the business cycle. So the market's always going to go up and down, and that's always going to remain. These are the terms that your book uses, but sometimes this is referred to as unsystematic risk, and this is systematic risk, and it's always going to be there because of the business cycle. Okay, so at this time, I would love to introduce Brian Remsen, who's a financial advisor with the Central Texas Wealth Management Group out of Wells Fargo. Brian and I are both on the board of the Young Professionals with the Chamber of Commerce, and he's been a great asset to have on our team. So I've invited him to come and just share a little bit about what he does. So this is stuff that he thinks about every day and deals with every day. Very, very important. And he was an economics major at Baylor as well. So, and then we'll open it up for questions. So please join me in welcoming Brian.